God morgon och välkomna till Paretodesken. Idag har vi vår strategiuppdatering med Chris Watling från Longview Economics som vi samarbetar med när det gäller strategi och macro-outlook. Welcome Chris, please take us through your latest research.
Morning, Stefan. Yeah. Well, I mean, yes, I think we're increasingly worried about this stock market. It seems to us the bear market's ongoing. It's interesting because market participants are getting quite excited about the move since the lows in early October. Clearly, we've had a strong rally, and people are getting more confident that there's more to come from. I mean, the bulls are arguing that we've had peak Fed hawkishness, we've had peak inflation. And there's certainly a lot of chatter in the markets about whether or not we can get a soft landing. So you saw the Atlanta Fed GDP now forecast is running about 4%. And so there's certainly a narrative growing in markets that this new bull market has begun. But that's not our view. We think there's plenty of key reasons why this bear market's ongoing. It's interesting to us that if you look at our key risk appetite models, they gave good buy signals in late September, early October. They're now back on to sell, telling us that there's quite a little bit of complacency, a bit of greediness built up in the market. And if I stand back and think about the fundamentals, it seems to us the recession case continues to build and get stronger and isn't priced by asset markets. You can look across a range of asset markets, and I would argue that recession's not priced in any of them, really. It's not priced in earnings expectations. It's not priced in a load of commodities, or certainly not in parts of the bond market, or even if you look at the equity risk premium of the equity market. So we've got that. We've also got the argument that the Fed is still tightening. They're doing interest rate hikes. Maybe peak hike is priced in, but the QT is ongoing. Liquidity is tightening up, and really the best indicator, I think, of where the valuation of the market goes is QE on or QE off. And in a phase of QE off, liquidity is tightening up. The valuation has typically gone down. That's the pattern of the last 15 years. Added to which, stress continues to build in the global financial system, of which FTX is one small example. The British pension fund debacle in late September was another example, and I find it hard to believe that there won't be more incidences coming. So yeah, we're still negative on equity markets. We're bearish, and we've increased our underweight towards that asset class, and that's what we've been focused on over the last week.
And that's a tactical perspective, which is typically like 1 to 3 months. Is that correct?
Well, that's both tactical and strategic. So it's both the shorter term, month by month, and the longer term, multi-quarter time frame. So yeah, the bear market, I think, is ongoing, and that's what we were laying out in our analysis last week.
Yeah, just a couple of follow-on questions here, Chris. If we have this scenario coming through, do you think that the Fed will have to change its stance and start support the economy during the first half of next year, and how could that impact equity markets?
I think at some stage the Fed will have to change their stance. It's back to that old saying, isn't it? The Fed normally tightens until something breaks. It's just a question of what they consider significant enough, sort of blended against what's inflation doing. So, that part of that judgment will be how much inflation's come down that makes them feel they're able to change their stance. So I'm sure over the course of next year that'll happen. I think that's highly likely. But it's just a question of the speed that, and where inflation is now, it's still pretty high, as you know. So it's going to take some time for it to come lower. So it's that balance of where inflation is and the size of the thing that they break, the size of the stress that manifests itself in the financial system.
And if we take a look at the market multiple for the S&P at the moment and consider possible earnings revisions, and how does that dynamic look, do you think?
Well, if you just take the S&P 500, which is obviously the main sort of market in the world, it's trading on a forward PE ratio of about 17, 18 times, and its sort of long-term average is about 15 or so. And the range is 25 down to single digits. So, and of course in that you've got earnings expectations which aren't discounting a recession yet. So there's plenty more potential downside. I mean, generally in a recession, earnings will go down 15 to 20% in terms of earnings expectations. So you've got that, and you've got the multiple that needs to come down. So there's room for meaningful downside from here.
Okay, that's very valuable insights, Chris. Thank you very much.
Thank you. Thanks a lot. Thank you.